Hello and welcome to MEPL Classes, everyone. This is your fifth class for CFA level 1 and third class with me. I hope everybody is having a great time, and today we will be continuing with financial statement analysis. However, before we begin our class, let me just go through how you can buy the MEPL Classes CFA curriculum. To get the CFA curriculum, go to meplclasses.com. Like you can see on my screen, meplclasses.com. On this, you can go to courses. From courses, go to international courses. Once you get to international courses, you can select CFA, and here you will get your classes. This is the final class, I think, that will be on YouTube. After that, we will only be available on your MEPL applications via your mobile phones or laptops. This one, the first option that is available, you can see the mobile symbol sent here. So this means that the first option is for mobile phones, and the second one is for laptop. So make sure you buy the right one. However, if you have bought the wrong one, you can contact our support team and they will be there to help you throughout. Now, before moving forward, everyone who is watching from YouTube, please like, share, subscribe and press the bell icon so that you know when we are coming up with new videos to help you with your studies. CFA classes are ready for you. Okay, so before moving forward with new classes, I hope everybody remembers what we did in the last class. In the last class, we did LOS 18 and we understood about the statement of financial performance. What is the statement of financial performance? The profit and loss account. So that is what we learned about in the previous class. Those who have not done that class, you can go to our YouTube channel and that class is available on YouTube channel. Now, today we are going to start with LOS 19, which stands for understanding balance sheets, or what else do we call it? The statement of financial position. Statement of financial position or balance sheet as we call it. What does the balance sheet tell you? A balance sheet of a company? I hope everybody remembers. We have done this in every class that we have been through. A balance sheet tells us the financial position of a company on a particular date. What are the components of a balance sheet? Assets, liabilities and owner's equity. We are going to learn about everything in detail, including the sub components of the balance sheet. What are assets? What are the components of assets? What are liabilities? The components of liabilities. What makes up liabilities? And what do you mean by owner's equity? What are the different bifurcations of owner's equity? This is all that we are going to learn in today's class. So I hope that everybody is ready. Be excited, and we are going to start now. Okay, so this is again, as we do in every class, this is just what the CFA Institute wants us to understand. Once you have completed this chapter, this is all the questions you should be able to answer. So what are these? Describe the elements of the balance sheets. I hope that everybody knows this already because we have done it in LOS 16. So what is the meaning of assets, liabilities and equity? Describe the uses and limitations of balance sheets in a financial analysis. So we are going to become financial analysts, everybody. We are not just preparing balance sheets, we are analyzing it. So we should be able to tell what are the pros and cons of a balance sheet while doing the financial statement analysis. Next, we come to describe alternate formats of balance sheet presentation. This is also something we have touched upon briefly. However, we will be doing in much more detail in today's class. Then we move to distinguishing between current and non-current assets and current and non-current liabilities. We all know, we did again yesterday in the previous class, we did the meaning of current and non-current. However, again today we'll be doing them with examples and the meaning of the different types of assets and liabilities. Next, we move to describe different types of assets and liabilities and the measurement basis of each. I hope you all remember that too, but again we'll moving into much more details. Next, we come to describe the components of shareholders equity. 19G tells us demonstrate the conversion of balance sheets to common size balance sheets and interpret the common size balance sheets. So in the last class we did common size profit and loss accounts, in which what we did, we presented all line items of a profit and loss account as a percentage of the revenue. So what will we do in balance sheet? Be ready to learn today. And finally, but last but not the least, calculate and interpret liquidity and solvency ratios. So as you move forward, you will understand that ratios are something that are very important in any sort of financial analysis. You might have heard about cash ratio, current ratio, quick ratio. We learn about everything today. So for doing any sort of financial analysis, you will be asked about ratios. In fact, let me tell you a fun fact. In my interview, when I went to sit for some large MNC's interview, I was also asked the similar question. I was asked about ratios. I was asked to describe various kinds of ratios, including these quick ratio, current ratio, cash ratio, everything. So be excited. We are going to learn everything today. Let's move forward. So our first slide for the day, we will understand the meaning of assets, liabilities and equity. I hope that everybody has a basic idea of what everything means. These are the three components of a balance sheet. A balance sheet is made up of assets, liabilities and owner's equity. So the balance sheet is also known as the statement of financial position. We all already know that, or the statement of financial condition. This is a new term, and you should always remember new terms. We should know what we are dealing with. It is a statement, it is a financial statement that gives a snapshot of the company's assets, sources of capital, that is the liabilities and shareholders equity at any specific point in time. We have already discussed this, and this provides vital information what the company owns, what it owes and the owner's claims are. So now let us understand the assets portion. For that, let me open the financial statements of everybody's favorite company. I hope you all remember which company I'm going to talk about. One second, there is some issue. Yeah. Please hold on a second while I open the financial statements of everybody's Facebook company. And I hope that everybody already knows which company I'm going to talk about, because this is the one company we have been talking about since the last two classes also. We will open its financial statements and we will look into the line items of its financial statements to understand everything in detail. So this is it. Facebook, everybody's favorite company. Let's get into the balance sheet of Facebook, and then we'll talk about the components of balance sheet while looking at the balance sheet of Facebook. Okay. So like we said, the three components of any balance sheet is assets, liabilities and stockholders equity or owner's equity. So what are assets? In the words of the book, assets refer to the resources which a company owns or controls because of past events from which future economic benefits will be derived or which are expected to flow. Now what are the important terms? The first and foremost thing is that the existence of an asset is based on any past event. So what is the past event? The purchase of the asset itself. For example, let us say for Facebook, it might be the servers of the company, the offices that the company owns. These all belong in Facebook's balance sheet because they bought it at a past date. They all Facebook bought it and it is present in the company's hands and they can use it for their benefit. And what is the second important thing? Future benefits are expected to flow to the company because of those assets. Asset means any benefit that will flow to the company. If there are no future economic benefits that the company expects, then it cannot be called an asset. If we consider a car, if we consider any servers that the Facebook company owns, any buildings, why does the company own it? Because when the company is owning it, they will be using it for economic benefits to the company. They might sell it or they might use it for their own purposes. If they sell it, they will outright get cash or cash equivalents, and that is an economic benefit. What is an economic benefit? Monetary. There should be some monetary gain to the company for it to be termed as economic benefit to the company. So what are the two things that we learned in understanding assets? Number one, the company owns or controls it because of a past event. The existence of a past event is necessary for it to be called an asset. And what is the past event in case of purchase? The payment that we make or the transaction of purchasing that asset is the past event which occurred for the company to own that asset. And the second thing that we learned about asset was that any future economic benefit is expected to flow from that asset. The future economic benefit can be through use of the asset, or it can be through sale of the asset, or any other matter. But there should be economic benefit, not any other benefit, but economic benefit that the company should have from owning that asset. Remember these two, because when we move forward and we talk about examples, I will be asking you those questions, whether or not the economic benefit is flowing to the company from the ownership of those assets. Next we come to liabilities. What is the similarity between assets and liabilities? Even though they are said to be complete opposites, but the existence of the past event, the obligations occur because of past events. So the past event is the thing that connects an asset to a liability. A liability cannot exist without any event occurring. So for example, when I said that Facebook as a company is going to buy machinery, they are going to buy land. When they buy it, they can buy it through payment in cash, or what they can do instead is that they can say that we are a very reliable company. You can see our balance sheet, you know where our offices are. So we'll pay you at a later date. We'll pay you in 1 month. So when Facebook tells their creditors that we will be going to pay, we'll pay you 1 month later, at that point of time, what they do is create a liability. A transaction took place where Facebook took assets from a company, took it with themselves, and created an obligation of on the company to pay those creditors at a later point of time. So that obligation, the existence of an obligation because of a past event. Liability is an obligation because of an existence of a past event, and their settlement is expected to result in outflow of economic benefits. In assets, we learned there is inflow of economic benefits. Economic benefits are expected to flow to the company. We'll be getting any economic benefit. In the case of liability, it is completely the opposite. We expect, because of a past event, an obligation is created which will result in an outflow of economic benefits. So what are the two things that we learned about both assets and liabilities? Existence of a past event and inflow or outflow of economic benefits. So this is the definition of assets and liabilities. Everybody should remember both the points that we talked about, assets as well as liabilities. And now finally, owner's equity. What is owner's equity, everybody? Okay, so it's a very simple concept to understand. When we open a business or entity, we are not going to open the entire business on credit. We are not going to go to a credit and ask for cross and loan, and we can just open the company on loan. There should be some personal investment that we make. That initial investment that we make is owner's equity. It keeps on changing year to year from profits and other transactions. For example, let us say I started a company with 1 lakh equity, my own equity, and I used 1 lakh of loan. Now during the financial year, I earned a profit of 20,000 rupees. At the end of the year, I will be saying my owner's equity component is 1 lakh plus 20,000, that is 1 lakh 20,000. So let us read the definition as given in the book. Equity or shareholders' equity refers to the owner's residual interest in the company's assets after deducting all its liabilities. So in simple terms, how we define equity is, one second. So equity equals to assets minus liabilities. or assets equals to liabilities plus equity. This is the definition of a financial statement. This is the equation. So you can be asked what is the equation of a balance sheet in your exam, and you can be given three options. Let me show you what kind of questions we are getting in exam. So if the question is, what is the equation of statement of financial position? Number one, revenue minus expenses equals to net income. Number two, assets equals to liabilities plus equity. Or number three, they can give assets equals to liabilities minus equity. So this is the kind of question that you might get in an examination setting. So in this case, we need to know the meaning of statement of financial position. Do not get confused in the statement of financial position and statement of financial performance. I have seen people get confused, but understand, position is a point of time, whereas performance is over a period of time. So profits and losses are earned over a period of time, but assets and liabilities are valued at a point of time. So position means balance sheet and performance means profit and loss. So if the question, instead of what is the equation of statement of financial position, had this been statement of financial performance, our answer would have been different. In this case, the answer is B, or assets equals to liabilities plus equity. I hope everybody is clear with this. So we learned about the components of the balance sheet or the statement of financial position or statement of financial condition. Moving forward, let's move forward. So what are the uses and limitations of balance sheet? What does the balance sheet tell us? We all learned that what are the components of the balance sheet? Assets, liabilities and equity. So a balance sheet tells us about these three. Why are these important? As an investor or as any sort of financial statement analyst, I need to understand why are these values important to us. So first and foremost, let us take the perspective of an investor. I am going to invest in, let's say again, Meta. And when I go to the company, let me show you something. Meta. Okay, Meta share price. So I can see that the Meta share price currently it is trading for 114 USD per share, right? At a PE of 10.89. So if I need to buy even one share of Meta, I need to pay $114. Why will I do that? So what do I need to understand first and foremost? What is the total value of the company? How much assets does the company own? How much liabilities does the company own? If I buy one share, what is the owner's equity component? What is my component in the financial statements? That is how I'll understand that the value of the company. This is the starting point. So in case of Meta, let's see, it's in millions of dollars. So 165,987 million dollars. This is the total balance sheet value of the company. So this gives a starting point. This gives us a starting point of understanding the total value of assets and total value of liability plus owner's equity for the company. So the balance sheet gives us insight into the financial condition at a particular point of time. What does particular point of time mean again? So these values are as on 31st December 2021. So on that date, these were the values that were assigned to the assets. Now every day the company is making thousands of transactions, so these value keeps on changing every day. However, in the annual report we get the value on the last date of the year, that is 31st December 2021. However, this date can change depending on the country you are in. So for example, in India, we use the 31st March date. That is the ending of the financial year of our country. So India's financial year runs from 1st April till 31st March. So that will be the balance sheet date in case you look at any balance sheet of an Indian company. So now the balance sheet can assist analysts in assessing a company's ability to do what? What does when I look into the balance sheet of Meta and I see cash and cash equivalent is $16,000 million and marketable securities are $31,000 million. These are some things that we might not have discussed yet, but I hope that everybody can understand the meaning of cash. So when I see they have $16,600 million in cash, what can I say? What do I get the gist of? That the company does not have any liquidity problems immediately. The company is not going to get bankrupt. When people ask, when their creditors come to ask for money, the company will be able to pay them off. So the company is not going through any financial trouble immediately. Right? So they will be able to pay for its near-term operating needs. That is, the liquidity position of the company is solid. The company have enough cash and cash equivalent in its hand along with other current assets. Although this is a very crude measure what I am saying, because we are looking at absolute measures. What we should actually be looking into is ratios. We will be discussing that again in the end of today's class. Okay, we will be calculating the ratios of Facebook for better understanding. Okay, so meet future debt obligations. So apart from near-term operating needs, when we look into the long-term assets of the company has $57,000 $57,000 million in property, plant and equipment. So the company does not have any monetary issues, and the liabilities of the company amount to 41,000 million. So the company has significant owner's equity. The company does not have much liability, however the assets are significant. So the company is not going through any financial trouble. We are being able to say that the company will be able to pay for not only its near-term operating needs, but it will also be able to meet its future debt obligations. And finally, after paying off its liabilities, the company has enough money left to make distributions to the shareholders. So what we can look at, let's see. Let us look at book value per share of Meta. So the book value per share is $46. So what does book value per share means? It divides the total owner's equity divided by the total number of shares outstanding. So like I said, when I go into the open market, I can buy one share of Meta. Does that mean that I am the absolute owner of Meta? I can just say, Mark Zuckerberg, get off the seat and let me have the seat of the CEO. I cannot do that. What does one share mean? The company has millions and millions of shares. 5,000 million class A shares, 2,328 million issued and rest outstanding. So the company has so many shares outstanding. When I buy one share, I am just a minute, very tiny owner of the company. That does not give me any absolute right. However, while investing, I will be able to understand. When I look at the book value per share, I will understand that I am going to get this much book value for the asset. So the owner's equity component to total shareholders equity is $124,879 million divided by the total number of outstanding shares that have been issued will give us the book value per share. Now when we get the book value per share, and then we can compare it with the market value to understand how much are we overpaying. So if the company, let's say the company goes wants to close his business today itself, and we'll be able to realize all assets at its book value. So the company has $165,000 million, and after paying off all its liabilities, that is $41,000 million, I will be getting, if I have one share, I'll be getting roughly $46. That is the meaning of book value per share, right? And it is a very important thing for us to understand that when we are buying shares in the market, we are not buying at book value, we are overpaying. For Meta, for example, we saw we are purchasing the shares at around $114, whereas the book value is only $46. So why are we overpaying? Because we expect that the company will be able to earn profits after profits year after year, and the value of the shares will keep on rising. That is why we are able to make a decision of whether or not to buy the shares depending on how the company is performing year after year. We cannot just look at the balance sheet, we have to look at several other aspects, including the statement of financial performance like the profit and loss account. We have to look at the cash flow position of the company, the management discussion and analysis section of the annual report, and everything else that we have already discussed. We have to look at everything as a whole, and then make a final decision of whether or not it is a good investment for us to move forward. So I hope everybody understands the uses of of the statement of financial position. Like, it helps to assess the liquidity, whether or not the company can meet its short term short term operating needs. So liquidity is short term, solvency is long term. Solvency is a term related to long term. Liquidity means meeting short term obligations, solvency means meeting long term obligations, and the ability to make distributions to shareholders. Oh, it's written already. So these are things that you need to keep into mind: the uses of balance sheet and its usage to a financial statement analyst. Apart from what's already written, I hope that you also understood how practically we can use balance sheets to make a sound financial decision to whether or not invest in a company. Next, let us look into the limitations. What are the limitations of a balance sheet? So last time, I think in last class, when we were learning about measurement basis, we learned about so many different costs. We can record any asset at market value, we can record it at historical cost, at amortized cost, current cost. There were many options that we read about in our last class. Without understanding that in detail, when we look, see, some assets are measured at historical cost, some are measured based on their fair value, which represents its current value on the balance sheet date. These differences can have a major impact. So what does this mean? This gives management the right to present their balance sheet the way they want. This can be used by many managers who are unfaithful to manipulate the market. So this has been something that has been a major issue, and that is why audits are conducted to make sure that management cannot manipulate their financial statements. However, as a financial analyst, you need to make sure that you understand that there are chances when a management can commit manipulation of the statement of financial position. That is why while reading any statement of financial position, we need to make sure that we read the accounting notes that have been annexed along with the financial statements. That is why explanatory notes have been made an important component of the financial statements. Next, we learned that the balance sheet is on a particular date. That is, in case of Meta, it was 31st December 2021. However, it keeps on changing every day. We do not get every day's data. So we need to make sure that whenever we are analyzing any company, we not only take the latest data that is available with us, we understand the implications of the changes that might have taken place in the balance sheet from the day of reporting the balance sheet till today. So today is 7th of December 2022. And we are looking at a balance sheet which was reported on 31st of December 2021. So almost one full year has passed. We cannot rely on that data. That data is not reliable as on date. We need to take the latest data that is available. For listed companies, they are mandatorily required to report their financial statements every quarter. So that will be available to us. However, for unlisted companies, they might not be required to report their balance sheets quarterly. So please make sure before investing in any company, you take a look at the latest data. And finally, some assets and liabilities are difficult to quantify and are not reported in the balance sheets. So for example, let us take a company like Tata. Tata is one of the highest rated companies in reliability. Whenever as consumers we hear the name of Tata, we are almost guaranteed that the brand will have certain quality. The products will be of certain quality and it will not disappoint us. So what does that feeling of loyalty, the feeling of brand quality? We know that as a brand, Tata will not disappoint us in terms of quality. That is something that is attached, the values attached to the name. However, we cannot quantify this. How will I say that? Is the name of Tata worth $100, $1,000? What is the value of the brand loyalty? What is the value of the company's name? The human capital of the company. What is human capital? Let us say that I am working in Tata. So what is my value while I'm working at Tata? I am paid a salary that is expensed. But my intelligence, my experience, the value that I bring to the company, that cannot be quantified. So these are certain intangible things that cannot be mentioned in the balance sheet. So these things are often escaped and they cannot be properly presented. However, while making a financial analysis, we should also keep these things in mind. Let us say, for example, I am going to invest in a new company, a small cap. Small cap means smaller companies, companies with lower shareholders equity, lower asset bases. So if I'm going to invest in a small company, I should first examine what is the name, what is the value that people attach to the name of that company. Is there any brand loyalty attached? Is there any human capital that is relevant to the company? So only after understanding these points can I make a sound financial statement analysis. Okay, let me tell you of one thing that will come much later, but let me just discuss it once. So there's something called the key man risk. What is a key man risk? A key man risk means, let us say a company is completely dependent on one single individual. That might be Tesla. Elon Musk is the one individual who is running the whole show. He is the manager. He is the final man for anything in Tesla. If Elon Musk dies, he suddenly has an accident, then the entire value of Tesla can fall in a flurry. So what is that risk? The risk is called key man risk. Elon Musk is the key man and he is the person who is running everything, and in case anything happens to him, the entire company is going to suffer badly. That is the key man risk that is attached to that company. Like the risk is attached, the same is the benefit. If you look at Tesla as a company, the company does not have as much book value. It is trading at several multiples above its book value. For example, if the multiple is, if let's say the book value is $1, then the company is trading at 40 or $50. I do not remember, it's just a rough estimate, but it is trading several multiples of its book value per share. Why is that? Because people have that trust that Elon Musk as a CEO and as an entrepreneur is going to take the company somewhere and they will be able to earn profits through his in time. That is why the human capital is being valued. The human capital of Elon Musk is how Tesla is being valued. So we need to look at everything. Okay, so now what are the limitations of balance sheets that we read about just now? Number one, assets and liabilities have different measurement bases. They can be valued at current cost, present value, they can be valued at amortized cost, historical cost. We need to understand what the management is using to value their assets and liabilities, and whether or not the management is doing any sort of manipulation with their accounts. Second, we learned that the value of the item reported on the balance sheet is as on a particular date, and the date, as the time moves forward, the values keep on changing. However, when we look at any balance sheet, we are going to get the value of only one particular date. And finally, some assets and liabilities are difficult to quantify and measure. For example, we talked about customer loyalty, brand value, and human capital. So these are not a part of financial statement, the statement of financial position. However, they are very, very important to the company and should be considered in our financial statement analysis. So even though we are not considering these items in the balance sheet, they are very important to the company. So I hope everybody understand the uses of the balance sheet and the limitations of a balance sheet. Next, we will come to alternative formats of balance sheet presentation. So in our entire readings, we are going to focus on two reporting standards. In LOS 16 and 17, we talked about standards, what are reporting standards, and we talked about IFRS and US GAAP and many other standards. But in CFA course, we are going to get into the details of two of these. IFRS, that is the International Financial Reporting Standard, and the US GAAP, or the United States Generally Accepted Accounting Principles. These are the two standards that we'll be focusing on, and we'll be understanding what are the implications of following the different accounting standards and how the items of assets and liabilities can be presented in different ways depending on which standard we are following. For example, in last class, when we were reading about inventory, we heard that LIFO is last in first out method of inventory, which is allowed in US GAAP, but it is not allowed in IFRS. So that is something that we learned in the previous class. I hope everybody remembers, because this is very, very important. And similar to this, we'll be learning about many different presentation formats and many different classifications for assets and liabilities that are allowed in IFRS or US GAAP and not allowed in the different standards. So we will be learning about two standards in our CFA curriculum. So what are the different types of formats? The format that we currently look at, this one. I hope everybody remembers that this is called the classified presentation format of a balance sheet. What is a classified presentation format? This means that assets are divided into current and non-current, whereas liabilities are divided into again current and non-current. Whenever you see the words current and non-current, you will understand that they are meaning assets, and that the presentation format of the balance sheet is classified. So it is known as a one second. So it is a classified balance sheet. Whenever the word current and non-current are present, we are dealing with a classified balance sheet. However, under IFRS, firms can choose liquidity based format if the presentation is more relevant or reliable. What is a liquidity based format? It means that the assets are being presented in order of their liquidity, from most liquid to least liquid. So this type of presentation format, in this, for example, if you look at I will show you at the end of the class. If we do get the time, we will be looking at a liquidity based balance sheet format. So let's say cash and cash equivalent will be first. Then marketable securities, which are very similar to cash. Then accounts receivable, fixed assets, etc. So cash and cash equivalent are the most liquid asset because they are already in cash. Similarly, marketable securities are financial secure. They are For example, treasury notes, these can be sold very fast, so that's why they're almost similar to cash equivalents. So these two can be are the most liquid assets that are owned by a company and will be listed at the top. As we move lower, the level of liquidity reduces. Accounts receivable or money receivable from the debtors of the company or sundry debtors are the are are also liquid as their current assets. However, they are not as liquid as cash, which are available in money immediately to us. So this is how a liquidity based balance sheet is presented. What kind of companies will follow a liquidity based balance sheet format? The most relevant for this will be most relevant for financial companies such as banks and insurance companies. So like it's already mentioned here, that the banking industry will use a liquidity based balance sheet format. Why? Because for banks, the most important thing is money, and people will be coming to withdraw their money and take loans from the bank every day. And if the banks do not have liquidity, then the bank will not be able to continue with its operation. When we'll go to future further levels, we will be learning about how the regulators in every country have made certain mandatory provisions and requirements for banks. For example, banks are required to maintain a minimum level of money with them at all times, so that people do not have any trouble in withdrawing their money or in taking loans from banks. So for financial industries, when a company is a financial company such as a banking or insurance company, they can use they might use the liability based presentation or the liquidity based format. And in case of any other company, they generally go with the current non-current format, which is also called the classified balance sheet, which we have seen so far in every class. Now we will move to the meaning of current and non-current assets. I hope we already did this briefly in the previous class. We discussed what does current mean, what does non-current mean, but do not worry, even if you have not learnt about it in the previous class or you did not understand, we are going to discuss it again. We are going to understand the meaning of current assets and the meaning of non-current assets before moving forward. So, what is current? Current assets are those assets of the company that will be used in the within 1 year or within one operating cycle. These are those assets that are held for trading and are expected to be sold, used up, or otherwise realized in cash within 1 year or one operating cycle. Where is okay? So what does operating cycle mean? We need to understand the meaning of operating cycle. What does operating cycle mean? So if any asset is realized within 1 year or within one operating cycle, then it is known as a current asset. So for that, we need to understand the meaning of an operating cycle. Let us say as a company, I purchase an asset. That is my regular operations for the company. This is not any long-term asset that I'm buying. This is the asset that I normally deal in. So the date from buying the asset to making the sale to realizing money. The total time taken to do all these three things is called the operating period or the operating cycle. In case it is less than 1 year, then is it important for us? For example, let us take a small company which sells steel. The company will be buying steel today and they'll be able to sell it today and they might realize it 1 week later. So what is the operating cycle for such a company which is involved in trading? In such a case, the operating cycle is only 1 week. The company is turning over whatever they are buying within 1 week. They do not have any relevance for the operating cycle to determine current or non-current assets. For such a company, what will they look at? Such a company will look at 1 year. So if they're realizing an asset or they're using an asset within 1 year, then that asset is a current asset for them. However, in case operating cycle is greater than 1 year, that is when the complication arises. In that case, we won't be looking at whether or not the asset is being realized within 1 year. What we will be more interested in is whether or not the company can realize the asset within one operating cycle. So for example, let us consider again a construction company. If a construction company is going to buy its raw materials, it's going to construct the building, and it's going to make the sale and realize its money, let us say in 2 or 2.5 years, then in that case the operating cycle of that company will be 2 to 2.5 years, and the relevant time period to determine whether an asset is current or non-current will be 2 to 2.5 years. So that is what we have to keep in mind. We cannot just blankly assume that 1 year is the item. So in an exam, if it says that the asset will be realized within 13 months, then we'll just write it is a non-current asset. We cannot blindly do that. We have to make sure that the exam does not give any additional information. Like I already said, that when we get questions in our exam, how will we get questions? Let's say XYZ is a construction company. It takes 2 months to buy all raw materials after receiving the order. It takes the company 8 months to construct the building, and finally it takes 5 months to sell and recover money. The company has accounts receivable amounting to $1 million, which it expects to realize in 14 months. This is the kind of summary or story that you can be given, and then you will be asked whether or not the company will recognize it as a current asset, a non-current asset, and for the third option they might just write anything funny. For example, they might write liability. Account receivable, we all know that it's a asset for the company. I hope everybody is very crystal clear with that. So in this case, we will see that 2 months plus 8 months plus 5 months. So 15 months is the operating cycle of the company. We will calculate the operating cycle, and then since the realization is expected within 14 months, that is within the operating cycle of the company, hence we shall record this as a current asset in the books of accounts of the company. Current assets are assets that are primarily held for trading or which are expected to be sold, used up, or otherwise realized in cash. In this case, the accounts receivable were expected to be realized in cash within 1 year or one operating cycle. In our case, it was within one operating cycle after the reporting period. Reporting period is the date on which the balance sheet is being prepared. So for example, if I prepare the balance sheet today, today will be considered the reporting period. for most companies and for most countries, they decide one particular date, that is the end of the financial year, which in case of the United States is 31st of December, but in case of India, which is the 31st of March. So we hear that the reporting date will be the date on which the balance sheet is prepared, and as on date we will determine whether the asset is current or non-current. So from the date of reporting period, if the asset is being realized, used or sold within 1 year or within the operating cycle from the reporting date. So in case of Meta, we were looking at the financial statements or the statement of financial position as on 31st March 2021, and let us say the operating cycle of Meta is less than 1 year, so we'll be considering 1 year. So if the asset is being realized, used or sold within 2020, within 31st of December 2022, in that case the asset is current. Other than that, every asset will be recognized as a non-current asset. So non-current assets are, on the other hand, are assets that are not expected to be sold, used within a year or one operating cycle. These are oftentimes referred to as long-term or long-lived assets. They represent the infrastructure upon which a business entity runs or operates. So what does this mean? This is the infrastructure. A long-term asset is something that will be giving the company economic benefits for more than 1 year. What does this mean? That the company will be able to get economic benefits through the past event or the past transaction. The asset exists in the company's balance sheet, and the company will be receiving future economic benefits will be flowing to the company through that asset, and that will occur over more than 1 year or for more than one operating cycle. That is why it is said that that is the base on which the company stands. Like for example, Facebook, the example that we are going with continues, and we heard that servers of the company is going to use the servers again and again, year after year. The servers will be there with the company for more than 2, 3, 4, 5 years. So that is a long term asset for the company. That is a non-current asset of the company. That means that the company will be receiving the benefits of owning that server for more than one accounting period, for more than 1 year or for more than one operating cycle. And that is the base on which the company runs. That is the infrastructure. It includes the property, plant and equipment, investment property, goodwill, intangible assets. We will be coming to goodwill, intangible assets at a later point in today's class, and we're learning about them in detail. So let's just skip this for right now. Operating cycle we have already discussed, is the time taken to produce or purchase inventory, sell the inventory, and collect the cash. Now let us come to current versus non-current liabilities. The definition is very similar but not the same. So within 1 year wala thing, the 1 year thing remains the same. The liability is expected to be settled during the normal operating cycle of the business activity. That remains the same, right? However, there are certain differences when we talk about liabilities. Current liabilities are those liabilities that are expected to be settled within 1 year or one operating cycle. However, to be classified as current, a liability must satisfy one of the following criteria, any one. So if it fits the definition of any one of these 4 lines, then it is called a current liability. Any one needs to be fulfilled, not all 4, right? So first is, it is expected to be settled within one operating cycle. This is something which I have already gone through in terms of assets. So let us say that if it is a liability and I have to pay you for buying a machinery from you, and the last date for payment is within 20 days, that is less than 1 year. So if I have to pay you the amount in less than 1 year or in less than the operating cycle of the company, then it is a current liability. Number 2, the liability is held primarily for trading purposes. It is a trading liability for the company, such as accounts payable. That is when we purchase any raw materials, that is a trading item and it is a trading liability. That is also going to be recorded as a current liability. The liability is due to be settled within the year after the balance sheet date. We have already discussed this again. So operating cycle or this. So for assets, only point number 1 and 3 are relevant. 2 and 4 are something that are distinct or new that we are going to learn for current liabilities. So 1 and 3 is the same. That is, if the liability is going to be settled within 1 year or within one operating cycle, then it is going to be a current liability. Number 2 is primarily held for trading purpose. Or number 4, there is no unconditional right for deferral of settlement of the liability for at least 1 year after the balance sheet date. Now, what does this line mean? What do you think? Try to understand what does this line mean. If as a company, I receive any liability, let us say I took a loan of $1 million, and as per the agreement between me and my lender, I have to repay the money to him within 1 year. So since it is going to be repaid within 1 year, should I record it as a current liability? That is what common sense tells us. But we need to look deeper into the agreement. What if I have an unconditional right? Unconditional is important here. That is, there are no conditions involved. I can unconditionally defer the payment. I have the right to defer the payment to a future date. I have to pay within 1 year, yet I have the option to pay within 3 years if I wish, if I want to. The right should be unconditional. So there is an unconditional right, then it will not be a current liability. However, if there is no unconditional right, in case there is no unconditional right with me to defer the payment for beyond 1 year, then it will be a current liability. I hope everybody understands the meaning and the 4 points, out of which if the liability is satisfied if any of the points, then it will be referred to as a current liability. Next, any liability which is not a current liability is automatically a non-current liability. So non-current liabilities or long-term liabilities refer to all other liabilities, including financial liabilities such as the loan we were talking about, which might be repaid beyond 1 year. So please make sure financial liabilities can be both short-term or long-term. A short-term financial liability is a current liability, but a long-term financial liability is a non-current liability. Two examples are long-term financial liabilities and deferred tax liabilities. Again, we'll be talking about deferred tax at a later point of time. I hope everybody is clear about the first portion of the chapter that we have completed. Now we will be discussing what are the subparts, what are the different components of current assets, what are different components of current liabilities, and everything else. Before that, let us take a 10-minute break. It is 6:27. I'll be coming back at 6:37. So let us take a 10-minute break. Have your evening snack, have your tea, and I'll be seeing you back in 10 minutes. Welcome back, everybody. I hope everybody has had their break. Let us restart with current assets. So let us move faster because we are moving a bit slow for our pace today. What are current assets? We have already learned about that. So the components of current assets, what are different items in current assets? So we already know that current asset means those assets that will be realized, used within 1 year or within one operating cycle. So let us look at the examples and learn what is the meaning of every single one of those items. Cash and cash equivalents. This is almost self-explanatory. Cash, I hope everybody understands, is just the cash and the bank balance of every company. Cash equivalents are those items which were equivalent to cash or which can be easily converted into cash. For example, highly liquid investments. If, for example, I am a banking company, and as a banking company, they give 1 day, they can take 1 day loan from other banks. They often take that from the RBI also, or the Reserve Bank of that country, the central bank of the country. They take a 1 day loan. Those are convertible into cash, which is highly liquid. Those assets are highly liquid and can be considered under cash and cash equivalent. Demand deposit with bank is nothing but bank balance of the company. So the cash, bank balance and highly liquid investments with original maturities of less than or equal to 3 months come under cash and cash equivalents. Measuring cash and cash equivalents at amortized cost or fair value is not likely to produce materially different amounts. So if we measure cash and cash equivalent at amortized cost or at market value, that will almost be the same. There might be a few difference in pennies, so the difference will not even be relevant for us. So that is why it is said that it can be presented at amortized cost or fair value. Next, moving to marketable securities. These are also highly liquid. However, the maturity will be more than 3 months because the less than 3 months portion is covered under cash and cash equivalent. Include investments in debt or equity securities that are traded in public market. For example, treasury notes, promissory notes. These are highly liquid assets whose value can be determined from the prices since these are being traded in public markets. Further details on these financial assets tend to be provided in notes to the financial statement. So the company is compulsorily required by the accounting standards to provide additional details about these marketable securities in their notes to accounts. If, for example, a company owns any sort of promissory notes, treasury notes, then apart from their presentation as a current asset in the balance sheet, so let us see marketable securities. Facebook has presented marketable securities in their current asset section. However, again, we need to present additional details about marketable securities in the notes to accounts. I'm not sure whether US GAAP compulsorily requires presentation of additional details about marketable securities, but let us, however, take a look. For example, any Indian company will be required to present data about what will be the impact of changes in interest rate, what will be impact of liquidity problems with the company on the marketable security portion. So every Indian company is required to present that additional information if they are following the Ind AS form of accounting standards. See this. They have also presented the additional details. See, this is the breakup of marketable securities of Meta. When we saw in the upper section of the balance sheet, we saw the total value of the marketable securities. However, they are mandatorily required to present additional details. So, what are the marketable securities owned by Meta? The US government securities, the US government agency securities, corporate debt securities. These again are highly liquid. However, not as liquid as cash and cash equivalent. Hence, we learn about what is the meaning of marketable securities and cash equivalent. So this, see the component of cash and cash equivalent. This is within 3 months. So see, you can see that there are US government securities both in this portion, that is cash and cash equivalent, and in marketable securities. So what is the difference in this case? the government securities which are expected to be realized within 3 months, in less than 3 months, that is included in the cash and cash equivalents portion. And other than that, the highly liquid assets which are expected to be realized within the year or within the operating cycle is referred under marketable securities. I hope everybody is clear between cash and cash equivalent and marketable securities. Now let us move to trade receivable or accounts receivable. These basically mean the debtors that the company has. For example, I am in a business of selling steel. I sold steel to company XYZ worth $1 million, and I did not get the money immediately from that company. They said that they will be paying back the money to me within 1 week. Now, for that 1 week, the company XYZ will be recorded in my books as trade receivables or account receivables or debtors. Sundry debtors. These refer to the amounts that are owed to a business entity by its customers for its products and services that have been already delivered. So again, when are the accounts receivable recognized? We can go back to LOS 18 where we learned about revenue recognition. Only when the revenue is recognized, that is when the accounts receivable will be a corresponding amount that will be recorded along with the revenue. I hope everybody remembers the 5-step process of recognizing revenue. If you do not, please go back to last day's class and read about it again. That is a very important thing that we all need to remember. They are usually reported at net realizable value. So accounts receivable are recorded at net realizable value, which is their fair value less any provision for bad debt. So what is bad debt and what is a provision for bad debt? Let us learn about that. So let us say I am a huge company and I have hundreds and thousands of debtors, and my total accounts receivable in my books of accounts is $1,000,000,000. That is the total revenue that I have recognized, and that is the total value of sales that I have made and the bills I have raised. I want my customers to pay this much amount, but is everybody going to pay me back? Might be, might not be. So as a company, I need to make a decision. The management of the company might determine that 2% of the accounts receivable will not be receivable. That is, they will not pay and they will become bad debts. So what will I do? I will create a provision. I will already create an expense. I will already write it off so that my financial performance does not overstate the performance that I have done. I have sold $1,000,000,000 of my product or service, but I do not expect the entire money to be realized. That means if I state that I have made sales of $1,000,000,000, that will be not correct, because I do not expect 2% or $20 million to be received. So this is the provision that I am creating through my profit and loss account. And in the balance sheet, whenever I am recording my accounts receivable, I will be recording them net of the provision for bad debt. That is $980 million. I hope everybody understands the meaning. Let us just take a look again at Meta and whether or not they have presented their accounts receivable net of any provisions. Again, it is not mandatory. The management might determine that entire amount that is receivable will be received, because whenever Meta deals with customers, they take the money in advance. So for in this case, it might not have any bad debts. However, they might have presented it. Let us receivable. See, so they have also written net. What does this net mean? That is The provision has been subtracted from the accounts receivable. Okay, so they have not presented the value of the provision, but since the word net has been written next to the accounts receivable, what does that tell us? That the accounts receivable has been presented net of any provision for bad debt. Addition to the allowance in particular period are reflected as bad debt expenses. The balance of allowance for doubtful accounts reduces the amount of gross receivable to a net amount, which is the estimate of fair value. So the fair value is the amount that I expect to actually realize in the normal course of business. Next, let us come to inventory. We have already learned a lot about inventory. What did we learn? The different measurement bases, FIFO, LIFO, and weighted average. We learned about how FIFO and weighted average are allowed under both IFRS and US GAAP, but LIFO is only allowed in US GAAP. It is not allowed in IFRS. Okay, so LIFO is not allowed in IFRS. So this is something that we learned about yesterday or in the previous class. So what is the additional thing that we are going to learn today? What becomes a part of the cost? So cost includes all associated costs of purchases, cost of conversion, and all costs that are incurred in bringing the inventory to the present location and condition. What does this mean? Let us say I am going to purchase goods for my company, and to buy the goods I pay one more expense. What is that? Transportation. So I might include the value of the transportation. I am mandatorily required to include that as a portion, as a cost of inventory. Whenever I am going to value my inventory, I am going to include the value of any sort of expenses that I incur in relation to that purchase of goods, and that will be adding to the cost of inventory. What is cost of conversion? As a manufacturing company, I will be incurring other expenses. For example, expenses relating to, apart from expenses relating to buying of raw materials, there are many expenses that are incurred to convert the raw material to finished goods. For example, the cost of running the machines, it might be the fuel, the electricity. All those are called the cost of conversion, or the cost of converting raw materials into FG, or finished goods. So that is also to be included in the value of inventory and all other costs that are incurred in bringing the inventory to their present location and condition. I hope everybody understands the meaning of present location and condition. Now, under IFRS, inventories are measured at lower of cost or NRV, whereas under US GAAP, they are measured under lower of cost or market value. Let us understand this. Market value. Whichever is lower, that remains constant, right? So in IFRS it is cost versus NRV, and for US GAAP that is cost versus market value. We already understood the meaning of cost. So what is cost? Cost is the actual expenditure that we are incurring to bring the inventory into its present location and condition. It includes the amount paid, it might be the transportation, it might include cost of conversion, and any other expenses that are directly linked with bringing the inventory to its current location and condition. That is the cost. Now we need to understand the meaning of two terms. The first is NRV, or net realizable value, and the second is market cost. So the net realizable value is nothing but the money that the company expects to receive net of any expenses for selling it. If I expect to sell any goods through a broker, I will be paying certain brokerage, and let us say I will be selling the good for $1,000 after paying $10 as brokerage. So I will be expecting a net realizable value for that particular good at $990. So that is the meaning of net realizable value. It is equal to the selling price less any completion cost and disposal cost. What is completion cost? For example, let us say I have any work in progress. I purchased any raw materials and it has not yet been converted into finished goods. So to sell it, I need to first convert it into finished goods. So the completion cost, that is to convert the working in progress into finished goods, and the disposal cost, that is again the selling cost, the brokerage that we already talked about. So after deducting any expenses that are left to be incurred in terms of that particular point of inventory, and the final amount that I expect to receive for that amount of inventory is the net realizable value. So the net realizable value, again, let me repeat, is the expected selling price less any completion cost and any disposal costs. Excuse me. Okay. And but what is the difference between market value? So market value, it sounds like it's the same thing. It's the same thing as net realizable value. It is also the amount that we are receiving, but there is a slight difference. Market value is slightly different in the sense that market is usually equal to the replacement cost, or the cost that we will have to bear or to replace the item in our books of account. It is not what we are going to sell for, what we are going to buy for. That is the difference. For example, as a company, I might not have a very robust selling mechanism. So I might not be able to receive the fair market value for that product, and the net realizable value might be different in that case from my market value. However, there are two restrictions for market value. We must know. What are the two restrictions for market value? One second. So a market value cannot be higher than NRV. Market value in no case can be higher than NRV, and market value cannot be less than NRV minus normal profit percentage. Okay. So again, understanding this. So if we are going to receive the NRV, then we cannot say that the market value for that good is greater. We cannot overstate the value of inventory. What will overstating the value of inventory do? And what, as an analyst, we need to understand for that? As an analyst, we need to make sure that if the company records at market value, and if the market value according to them is higher than the net realizable value, then what they are doing is they're overstating the value of inventory. That is incorrect. And what does that do? That will overstate the entire balance sheet. And ultimately, since owner's equity equals to asset minus liability, if assets are overstated, what will ultimately happen? The owner's equity will also be overstated. So we need to make sure that any inventory which is being valued at market value cannot be higher than net realizable value. And what does this mean, that it cannot be less than NRV minus normal profit? So if let us say that we are saying that the NRV that we are expecting is going to be $100, and we expect that the percentage of profit we earn on it is 10%. So $90 is the value of the value of cost of that goods. If we come through the value on reverse, I'm sorry, let me explain that again. So let us consider that we expect that the NRV that we are going to receive $100 on a particular good that we are going to sell, right? We'll receive $100, and the profit margin, our profit margin on that good is $10 or 10%. So what does that mean? That we have spent $90 to purchase and to bring the good to their selling condition, right? Now, if we say that the market value of the good is less than that, it is less than the cost, then is that viable, or is there something wrong happening? In this case, this might happen when the company's management wants to understate their assets. If the company's management wants to lower the owner's equity, that is again manipulation. That is why, just to keep checks in place, it has been stated that the market value cannot be greater than NRV and it cannot be lower than NRV minus normal profit. I hope it's written here also. Market value is the current replacement cost, which cannot exceed the NRV and cannot be lower than NRV, let's say normal profit percentage. I hope everybody is clear with this. This is a very important statement and you must remember it. This is very important for your exam. If the NRV or market value of inventory now falls below its carrying value, let us say we bought a good for $100 and we spent $50 to convert it into a finished good. So its value in our books of accounts at present is $150, right? However, there's a major decline in market and the value of good falls to $10 or $15. So there's a significant decline in the value of goods. In this case, if the management wants to record its value at such a lower value, is it allowed? Yes, it is allowed. In case the value of the inventory falls below its carrying amount, if the value falls below its carrying amount, the company must write down the value of inventory and reflect a loss in a profit and loss statement. So the company should recognize the loss of diminution in value of the asset. Under both IFRS and the US GAAP, the company is mandatorily required to write down the value of the inventory if the value of inventory falls below its carrying value. However, there is one important thing which is not mentioned in this slide, which I would like you to know. What if the fall in value was temporary? The value of the good that I purchased was $150. The value fell to $20 and I recognized a $130 loss. However, next year the value again shot up back to $150. Can I again rewrite the value? Can I again increase the value? So there is a catch here. In US GAAP, it is allowed. One second. So US GAAP allows write back up. IFRS, not IFRS. IFRS does not. So keep this in mind that if the value of the asset recovers, then it is allowed. However, in case we purchase it for $100 and the value rose to $150, in that case, am I allowed to write the value up? Go back to the formula that we read about. What is the value in which inventory is supposed to be recorded? It is supposed to be recorded at the lower of cost or market value. So in no case will the value that is recorded in our books of account be higher than cost or market value. Even if the market value shoots up to double or triple and the NRV also shoots up to double or triple, we cannot record a price that is higher than cost. If there was an initial diminution and we wrote down the value of the inventory, however, if the value recovers, then only under US GAAP can we write back the value of the inventory up till the cost or market value, whichever is lower. I hope everybody understands this. Moving forward, other current assets. As the name states, these are other assets which are current in nature, that is realizable within one period, 1 year or one account operating cycle. these are not sufficiently material and require or require a separate line item. These all are clubbed together and mentioned as other current assets. These include items like prepaid expenses, expenses which have not been, the benefits of which have not been realized but will be realized at a later point of time, but payment has already been made. For example, electricity expense paid in advance. We have already made the payment, but the electricity benefit that we will be receiving is in the next period. So that is a prepaid expense. Now coming to current liabilities. What are current liabilities, everybody? Trade payable or account receivable. It is an example. For example, I am a trader and I purchase my trading good, the good which I trade in, from any person, and I do not pay them immediately in cash. So that person, when I make the payment, that person will be recorded in my books of account as trade payable or account payable. It is the complete opposite of account receivable or trade receivable. That is a very simple explanation for it, and I hope everybody understands. These are amounts that the entity owes to its suppliers for goods and services that they have been purchased. Notes payable, these are very similar. However, these are financial liabilities. What does that mean? That means if I have taken any small loan from any person temporarily from its creditors. For example, I take a small loan that is to be repayable within 1 year or within one operating cycle, then that person will be recorded as notes payable in my books of accounts. Next comes accrued expenses. What are accrued expenses? The benefits of which I have received but the payment has been pending. For example, what is the difference between trade payable and accrued expenses? So trade payable are for suppliers of goods and services which are directly related to my operations, but accrued expenses are other, the benefits of which I have received but which I will be paying at a later point in time. For example, again, electricity expenses. At the end of every month, if I have not made the payment of the electricity bill, then that electricity expense will be recorded as electricity expense payable, and that will be an accrued expense in my books of accounts. And finally, deferred income or unearned revenue. What does this mean? Any advance that I have received from customers. This occurs when a business entity receives advance payment before delivering the goods or services. So my customer pays me in advance and I will be sending the goods to him later on. So that amount that I've already received will be recorded as unearned revenue or deferred income. Now, let us come to non-current assets. This is a longer section of this chapter. Let us get to it quickly. I hope before moving to this, I hope everybody is clear with everything we have done till now. Let us just take a bird's eye view at what we have done. We learned about assets, liabilities and equity, the differences and the meaning of every single item. We learned about the uses and limitations of balance sheet. We learned about the alternative formats of balance sheet presentation, that is current, non-current. One is classified, and the one where everything is recorded in order of liquidity is called the liquidity based format or liability or based presentation, which is often used in the banking industry. Now, when we came to current and non-current assets, we talked about what is a current asset and what is a non-current asset. Then we moved to the current and non-current liabilities. We talked about different types of current assets and different types of current liabilities. That is all we have done till now. After finishing current, now let us understand the meaning of non-current assets. First, the first and foremost line item in non-current assets. Property, plant and equipment. In this case, it's written property and equipment. What is a property, plant and equipment? For a manufacturing firm, it might be the factory, the entire building. It is a plant, the plant of the company. Property might be land and building that the company owns. Machinery that the company owns to produce the goods that they own. Tables, desks that the company owns. This computer that I'm using or the webcam that I'm using. everything is classified under property, plant and equipment. These are the assets which will not be completely used within 1 year. They will be benefiting to me and will be giving me future economic benefits for more than 1 year or for more than one operating cycle. These are tangible assets. What is tangible? Tangible is anything that I can touch. If I can touch it, then that means it is a tangible item. It is a tangible asset and includes land, building, machinery that are used in any entity's operations. So let us say if as a company I have some additional money and I go and buy a land because I think that in my opinion the value of the land is going to appreciate. I'm not going to use that particular building or let's say land for the operations of my company. Will that be classified under property, plant and equipment? No. In that case, it will be recorded under investment property. So investment property and property, plant and equipment are very similar in nature. The only difference being that PPE or property, plant and equipment is used for the operations of the company, expected to provide future economic benefits for more than one financial year or for more than one operating cycle. Now, there are two models of recording PPE. One is the cost model and one is the revaluation model. Cost model or amortized cost model. I hope everybody remembers the meaning of amortized cost that we learned yesterday or in the previous class. That means historical cost of the asset plus minus any adjustments. In this case, adjustments might mean depreciation slash impairment. So these are the different adjustments, or there might be any additional other investment adjustments that are taking place. So the historical cost, that is the cost that I paid initially to buy the asset, including any cost that I paid to bring the asset to my place of operation, the total sum plus minus any adjustment for depreciation, impairment, etc. is referred to as the amortized cost. So under cost model, this is the value in which the property, plant and equipment needs to be recognized in the books of accounts of the company. Let us read. When the cost model is used, PP is carried at amortized cost, that is its historical cost less accumulated depreciation or depletion or fewer impairment losses. Depletion and depreciation are basically the same thing, that is the allocation of the value of the property, plant and equipment over its life. We have already done depreciation in detail and I hope everybody remembers that. However, revaluation model is different. So under revaluation method, the value of the asset is recorded at its fair value. So at the end of every reporting period, the fair value of the asset is found out and it is recorded at its fair value. However, this does not mean that the company will not calculate depreciation and depreciation will continue to be calculated. Yet after presenting depreciation, the company will show the value at its fair value at the date of revaluation less any subsequent accumulated depreciation. So just because the company is following revaluation method does not mean the value of depreciation will not be there. Depreciation will continue to be recorded. However, the asset will be recorded at its fair value. Okay, moving forward. I hope everybody understands. what is cost model and what is revaluation model. Remember, US GAAP, only the cost model may be used. However, IFRS allows both. IFRS allows both. US allows only the cost model. So we need to remember the differences. Don't worry. You know, in the end, we will be making a chart of what is allowed under US GAAP and what is allowed under IFRS, so that there is perfect clarity and you don't forget. Investment property is very similar to PPE. This is property used solely to earn rental income, capital appreciation, or both. So, like I said, in case of PPE, they are used directly in the operations of a company. For a manufacturing company, the factory building is directly used and utilized in the operations of the company. However, if I buy any land, just because I believe that the value of the land is going to appreciate. So why did I buy the land? For capital appreciation, for expected capital appreciation. And I might also rent that out land till the time I am selling it, and I might earn rental income on it. As long as the income is rental income and expected future capital appreciation, then it is classified as investment property. Under IFRS, an investment property may be reported using cost or fair value model. Fair value model is the same as revaluation model, right? However, under US GAAP, there is no specific definition of investment property. So there is no definition of investment property under US GAAP. Under US GAAP, the investment property might also be included in PPE. Internationally, PPE and investment property needs to be separated. However, US GAAP does not say that. I hope everybody is clear with everything that we have discussed till now. Moving forward. Now, like we said before, intangible assets. Now we are going to talk about intangible asset. What is the meaning of intangible asset and goodwill? The meaning of economic goodwill, accounting goodwill, and their classifications and their uses under both US GAAP and IFRS. So when we learned about PPE, what was one term that we used? It is tangible in nature. It is a tangible asset. So when we learned about tangible assets, what did we learn? That it is something we can touch. So when we hear intangible, what is the first thing that comes to our mind? Something that we cannot touch. So intangible assets are those assets which, even though will provide future economic benefits to the company, yet they cannot be touched, they cannot be seen, they are not physical assets, they are intangible assets. For example, patents, licenses, trademarks, goodwill, these all are intangible assets for the company. What is a patent, you might ask? For example, as an engineering company, I might I might invent a new product, I might invent a new machinery. Now, since I'm investing my money into inventing the new machinery, I will want to utilize the benefits of that new machinery for the longest time, and I will not want anybody else to utilize the benefits of my research and development, right? So for that, the government issues patents. We have to pay certain amounts of money to the government, and then the government will give us exclusive rights for a certain period of time to produce that particular good. That is called as a patent. Next, copyright. If I write any book and I will want that nobody else will be able to publish it other than me. For books, it's copyright. Trademark is the right to use name. For example, what if I want to open a new company, I want to name it Google. Am I allowed to do it? No, why not? Because Google owns the trademark on the name Google and the logo also. We have our MEPL Classes logo. If you want to use it, can you use it? No, because we will be getting a trademark. We have a trademark for our logo. That is why nobody else can use that trademark. So for a trademarked name or logo. So these are certain rights that the government gives us, and for which we have to make certain payments. Can we see a patent? We are not talking about the agreement. The agreement, obviously, we can see the agreement in the forms we are filing for the government. But can we see the right to produce? It is a right. It's not anything tangible. It is an intangible asset that the company owns. It has no physical substance, but can be identified. It can be identified. Identification is important. So patent can be identified through the agreement. Intangible items are similar to PPE in a sense. Example of unidentifiable PPE. So all those are identifiable PPE that we just talked about, such as patents, copyrights, trademarks, because there's an agreement. What about goodwill? What is goodwill? Goodwill means the name of the company, like we talked about brand value. Can we actually identify goodwill of a company? There might be several formulas that you might have learned in your accounting about valuing goodwill, but are those absolutely correct? Those are just estimates. You can never get a proper true value of goodwill. You cannot identify a goodwill. A goodwill is an unidentifiable intangible asset. We'll learn more about goodwill in the next slide. But before that, completing intangible assets, the US GAAP again permits intangible assets to be measured only the cost model. So US GAAP in case of both PPE and intangible allows only the cost model, but IFRS permits cost or revaluation model. What is one important thing that you need to remember for intangible assets? What is the difference in cost model? Just one name. So in case of intangible assets, the term goodwill is changed by the term amortization. So for IFR, for intangible assets, we will use the term amortization. The historical cost plus minus any adjustments, with adjustments might mean amortization, impairment, or diminution in the value of the intangible asset, or any other adjustment that might take place. So in case of intangible assets, the term depreciation is not applicable. The term amortization is applicable, even though they mean exactly the same thing. In case of an internally created identifiable intangible, what does an internally created identifiable intangible? For example, I develop a new product and I spent a lot of research and development expenses. That new product that has come into my possession, it is an intangible asset. The right, I have the know-how of creating that new product. However, those need to be expensed. They need to be put in the profit and loss account. They will not be recorded as an asset in the books of account. This is under both US GAAP and IFRS. However, there is one important thing that you need to know. Okay. So like we talked about development of I give an example of development of a new product, right? So we are expensing research and development. So it is required to be expensed under both US GAAP and IFRS. However, only IFRS, only in IFRS, it is required that we divide the new product development into two phases: research phase and development phase. See, so IFRS requires an entity separately identify its research phase and its development phase, right? So what is the difference? During the research phase, there is no substantive proof or evidence that we will ultimately reach the research and development experiment will actually be successful. For example, I am developing a rocket science project and I am going to build a new rocket. When I start doing the project, there is no guarantee that my project will be successful and I will actually be able to produce that good. However, there will be a certain time when I will become definite that, and there will be a timeline for completion of that project. When I'm uncertain about completion of the project and I'm uncertain whether or not I will be able to do it, that is called the research phase. And when the certainty is arrived that we'll be able to develop it, that is called the development phase. We do not need to go into details of that. We just need to understand that there's a distinction between the research and development phase. In the research phase, all expenses are expensed. Everything, the salary of the research and development staff, the apparatus that we are going to buy, everything is expensed in the profit and loss account. However, the development, in the development phase, they are capitalized. What does capitalization mean? That means that those expenses will be recorded in the books of accounts as an intangible asset. Let us read. IFRS requires that the entity distinguishes between the research and development phase. Cost incurred internally generates intangible assets during the research phase must be expensed on the income statement or the statement of financial performance, while cost incurred during the development stage can be capitalized as an intangible asset if certain criteria is satisfied. We do not need to understand the other points of criteria that will be, you will be learning in your further stage in level 2 of CFA. For now, just understand that there are certain other criteria that might be mentioned, and once the company fulfills every criteria, then the development stage, only the development stage expenses can be capitalized as a intangible asset. The US GAAP on the other hand does not permit capitalization. Under US GAAP, all research and development expenses needs to be expensed off in the income statement in the year itself, during the financial year in which it is expensed itself. These costs can be startup costs, training costs, administrative, other general overhead costs, etc. Moving forward. Moving forward, we already talked about what is goodwill. Goodwill refers to the excess value created when we so this particular line item is mentioning about identifiable goodwill. When we go and buy any brand, let us say I want to buy the entire Meta company, or for example, let us take the hot example right now of Twitter. Elon Musk bought Twitter. Everybody knows that. He paid $44 billion to buy Twitter, right? However, when we look into the books of accounts of Twitter, did Twitter have $44 billion worth of assets? Let us see. Oops. Yeah. It has been delisted. The company was listed. However, after Elon Musk bought Twitter, it has become delisted. So we do not have any data about Twitter after its delisting. However, till it was listed in the stock market, we can find out its historical data. This is the trading values, financials, balance sheet. See, so the total value of the assets of Twitter was $14 billion, only $14 billion, as compared to the $44 billion that Elon Musk paid. He paid $30 billion extra for Twitter. Can you believe that? So what will be that additional value that he paid for Twitter be recorded as? If Elon Musk was a company and he recorded the value of Twitter in a company, then he will record as asset Twitter. He will be recording the $14 billion will be the book value that has come into his possession. However, the excess that he paid, the excess $30 billion will be goodwill. I hope everybody understands. So this refers to the excess value created when the purchase price of a company exceeds the buyer's interest in the fair value of the identifiable assets. So even though the fair value of the identifiable assets was only $14 billion, that is also before reducing the liabilities. Yet the excess money paid was the goodwill. Now there are two types of goodwills. I hope everybody got the concept of goodwill. The two types of goodwill are accounting goodwill and economic goodwill. So economic goodwill is only theoretical, and it is the excess value for excess value reflected in the entity's stock price. So when we look at the stock price, when we looked at Facebook stock price, for example, we saw it was trading for $114, whereas the book value was only $46. So 114 minus 46 gives us roughly 68. So that additional 68 is the economic goodwill of Facebook. Whereas accounting goodwill is related to accounting standards and is reported only during an acquisition. Like I talked about Twitter. So the additional 30 billion that Elon Musk paid is the accounting goodwill, and it is identifiable because he actually paid the additional $30 billion for buying Twitter. Both IFRS and US GAAP require the capitalization of accounting goodwill only. No economic goodwill is to be capitalized. Only accounting goodwill is to be capitalized. That arises from acquisition. However, when we say that the company has a goodwill, the company has a good name, that is why I paid extra for it. Now, can I amortize it? What will be the life of the goodwill? Now, like we talked about, it cannot be identified. The life of the goodwill cannot be identified. However, the company is required to test for impairment at every reporting date. Test it for impairment on an annual basis on the reporting date. What does that mean? That at every reporting date, we will check whether the value of the goodwill is diminished. And how will we check that? There is a goodwill test. And for example, one of the tests might be, we will determine whether any other person, if they want to buy Twitter, whether or not they will still be willing to pay $44 billion for it. Excuse me. For example, now Jeff Bezos wants to buy Twitter from Elon Musk, and he is ready to pay only $40 billion instead of $44 billion. So that $4 billion is the reduced value. The $4 billion is reduced from the value of goodwill. The new value of goodwill will be $26 billion as against $30 billion which Elon Musk has recorded in his books of accounts. I hope everybody is understanding that. Now, moving on to different non-current financial assets. What are financial assets? We will learn the book definition first. So IFRS defines financial instrument as a contract. What is a contract? An agreement between two parties. So an financial instrument is a contract that gives rise to a financial asset of one company and a financial liability or equity for the other entity. Financial assets include stocks, bond, derivative, loans, etc. Now let us look. So what is a financial instrument? Let us say two parties are involved, XYZ Limited and ABC Limited Company. These are the two companies that are entering into a financial contract, a contract or agreement. Let us take an example of how XYZ Limited wants to raise money. So they issue debentures. Issues debenture. What does issuing debenture mean? Means they will be giving debentures to ABC Limited, who will be holding the debentures in their possession, and they will be receiving interest against the debentures every year and the final principal payment at the end of the year. A debenture is basically a loan. So XYZ issues debentures. That means they took a loan from ABC Limited. So in this case, what does this give rise to XYZ Limited? XYZ Limited now has a financial obligation. they need to pay the interest and the principal to ABC Limited for holding their debentures. ABC Limited initially pays a certain sum of money to buy the debentures from XYZ Limited. Initially, they paid money to get debenture, and they got debenture in exchange from XYZ Limited. So XYZ has a financial liability in its books of accounts, whereas ABC Limited has a financial asset, because they will be receiving money, they will be receiving interest and principal from it. So that is a financial asset. Now, what if XYZ Limited had issued equity shares instead of debentures? Would that create a financial liability? Does XYZ Limited have to pay interest or principal back to ABC Limited? No, they do not have to, because equity is basically ownership of the company, and equity shareholders will get dividends at the discretion of the management. They might or might not receive the money. So, if they issue equity shares, then it will give rise to equity, increase in equity for XYZ Limited. But in case of ABC, they will still have financial asset. So a financial instrument is basically an agreement where financial asset is created for one party, which in this case is ABC Limited, and either financial liability or equity is created for the counterparty. I hope everybody is clear with the definition and meaning of financial asset and financial liability as also. They include stocks, bonds. Bonds are basically very similar to debentures. They also loans, receivable, derivatives. We'll be learning about derivatives in a whole different chapter. We will be learning everything about the meaning of derivatives, and we'll be learning about that later. But remember, derivatives are also financial instruments. They are financial assets. Okay, so now financial assets can be measured at fair value or amortized cost. Again, it is the same. What you understand the meaning of amortized cost and fair value? The measurement basis depends on how financial assets are categorized. The major categories for financial assets are given below. Okay, so this is very detailed. Before we move to this, let us take a 5-minute break. We will be continuing from 7:40. I'll be back in 5 minutes. Welcome back, everybody. So let us continue. We were understanding the meaning of financial assets and financial liabilities. We learned IFRS defines financial instruments as a contract that gives rise to financial asset for one company and financial liability for one company. Financial assets include stocks, bonds, derivatives, loans, and advances. I hope that part is clear. Now, at what value should it be recorded? There can be three methods of recording financial assets. First is cost or amortized cost. Number two, fair value through profit and loss. Number three, fair value through other comprehensive income. So these are the three options available. Can the company select any one on its own? Absolutely not. It is specifically mentioned what kind of financial asset is to be recorded under which head. So under IFRS, financial assets are recorded at amortized cost if two points. Asset cash flows occur on specific dates and consist solely of principal plus interest. This is called the business principal test. Whether or not the cash flows consist, cash flow equals to principal plus interest. Only principal and interest. And the business model is to hold the asset till maturity. That is, we are not going to, for example, it was a debenture. We said that XYZ issued a debenture to ABC Limited. Now ABC Limited is holding the debentures of XYZ Limited in its books of account as a financial asset. Now let us say that ABC Limited expects to hold the debentures till the date that they are repaid back by XYZ Limited. In that case, will the money that they are receiving be principal and interest of the debenture? Obviously yes. So what will be they receiving as cash flow? The cash flows they will be receiving will be against principal and interest for the debenture, and they will be holding the asset till its maturity. Only in that, if both these criteria are fulfilled, if both these criteria are fulfilled, then and only then can they record it at amortized cost. I hope this point is very clear. Under the US GAAP, amortized cost method is called held to maturity securities. Held to maturity, or HTM. So in case of the US GAAP also, it is the same. If there are held to maturity securities, they are to be measured at amortized cost, and amortized cost is equal to the original issue price minus any principal payments. Minus any principal payments. Any subsequent changes in market value are ignored. So amortized cost does not change with changes in market value. I hope that is clear for everybody. So which kind of financial assets are recorded at amortized cost? We have already learned about it, for which the cash flow test is solely principal and interest is received, and the assets are to be held till maturity. Next, we come to assets which are marked to market. Marked to market means they are recorded at fair value, and the difference between the book value and market value is recorded in profit and loss account or other comprehensive income. These two are called marked to market securities. The value of both these assets are marked to market on the date of reporting. The reporting date is the date on which they are both marked to market. Okay, now what is the difference? Number one, if the assets are held for trading, that is, I bought it and I expect to sell it, I want to sell it, they are held for trading. Under US GAAP, they are not called FVTPL, they are called held for trading securities. This category of asset is primarily for the purpose of selling in the near term and is likely to be held only for a short period of time. Any unrealized gains or losses are shown in the income statement. Let us take an example. Let us say that, let us give this example. XYZ Limited issued $100,000 worth of debentures. Case 1, ABC Limited expects to hold the debentures till maturity. In such a case, what will he do? Cash flow test, money received is only principal plus interest, business model test, the purpose, the business model for holding the securities is held to maturity. Since both are being fulfilled, it will be recorded at amortized cost. Now let us say, as on the last date of the reporting period, the value of the debentures increases to $120,000. This is the market value. So if ABC Limited wants to sell these debentures in the market right now, they will be able to sell it at $20,000 profit. So $120,000. However, in the first case, since it is being recorded at amortized cost, in the books of accounts there will be no change. ABC Limited income statement, balance sheet. Income statement will show the interest. Any interest income that might have received from the debentures will come here, and in the balance sheet the debentures will continue to be recorded at $100,000. I hope this point is clear to everybody. Now let us take case 2. ABC is holding the debentures for trading purposes. In this case, even though the cash flow test is being fulfilled, that is the money being received is principal and or interest, but the business model test is not being fulfilled. That is, ABC Limited is holding the debentures for a purpose to sell it. Now at the end of the year, what will they do? At what value will they record it? In this case, debentures will be recorded at market value, that is $120,000. And in this income statement, ABC Limited will record the interest income plus any increase in value of $20,000. So the $20,000 increase in value will be present in the profit and loss account or the income statement. I hope this point is clear to everybody. In second case, if they are held for trading, then the increment in value will be recorded in the profit and loss account. Unrealized gains and losses are recorded in the income statement. So they are unrealized because we have not actually sold it. So there is no cash money in our hands. But we know that the value has increased. That's why we are recording it. And finally, measured at fair value through other comprehensive income or available for sale under US GAAP. Under this category, assets are neither held for maturity nor to be traded in the near term. They are available for sale if the company receives a fair price for it. If the company receives a good price, they might sell it, but they do not plan to sell it anytime soon. In such a case, these securities are recorded as FVTOCI. That means when we saw the balance sheet of Facebook, see, after the net income portion, there are certain items mentioned in other comprehensive income. This is after the net income line item. I hope you are understanding this. So in this other comprehensive income, see, change in unrealized gains or losses on available for sale investments. I hope everybody saw that, and this is very clear. So if the financial asset is available for sale but it is not being held for trading or held in maturity, in that case any gains or losses or changes in value will be recorded in the other comprehensive income portion of the total statement of comprehensive income. So in this case, income statement will still present interest income. However, the change in value of the financial asset, the change in value will be presented as other comprehensive income and not in the profit and loss account. Okay, so IFRS allows both debt securities and equity securities to be presented as available for sale securities. However, US GAAP allows only debt securities. So the available for sale securities, that is the third portion, that is measured to fair value through OCI. IFRS allows both debt and equity to be recorded under this section. However, under the US GAAP, only debt securities can be recorded as FVT OCI. We have already discussed everything that is mentioned in this slide. We have also done an example. I hope you all remember the example of the debentures that XYZ Limited issued to ABC Limited. Everything should be crystal clear. If you have any queries, please feel free to contact us. Hmm. I'm just making sure that we have completed every portion and we do not have any point that we have missed. Okay. So there are certain points relating to IFRS and US GAAP that have been mentioned in your CFA book that I'll be just mentioning. Those are informational and should be remembered by everybody. In case of unlisted securities. If let's say a company XYZ Limited is holding the shares of an unlisted company, those are mandatorily required to be recorded at historical cost. Unlisted securities, amortized cost. They do not have the option of fair value measurement under both IFRS and US GAAP. They have to be recorded at amortized cost. This also includes any other item that does not have a fairly easily available market value, such as loans and advances. If you have taken any loan from a company, can you sell the loan readily in the market? Obviously no. So those financial instruments, even though they are financial instruments, they have to be recorded at amortized cost. Next, we come to IFRS, only IFRS treatments. There are 3 points. Number one, under IFRS, companies have an option to make an item recorded at FVT OCI. So a company can record any financial instrument irrevocably. They cannot change it in the future under FVT OCI. So under IFRS, firms may make an irrevocable choice at the time of purchase to account for equity securities only, listed equity securities, because we already heard that unlisted have to be recorded at amortized cost. So they have an option to record listed securities at the time of purchase under FVT OCI. Equity securities cannot be classified as available for sale under US GAAP. So this is an option that is available under IFRS. Number two, under IFRS, financial assets that do not fit any of the two criteria of FVT PL and amortized cost. I'm sorry. So under IFRS, any securities which do not fulfill the criteria of amortized cost or FVT OCI will automatically fall under FVT PL. And the gains and losses will be recorded under the income statement or the profit and loss account. And finally, under IFRS, let me write it down first. Under if not amortized cost or FVT OCI, then automatically FVT PL. So that is the so that means that this is the dump category. If the criteria of amortized cost or FVT OCI is not being fulfilled, then FVT PL shall be followed. This is under IFRS. These points are mentioned under IFRS. And finally, under IFRS, firms can make an irrevocable choice to carry any financial asset under FVT PL. This option is not available under US. Irrevocable choice to record any financial asset as FVT PL. So under IFRS, firms can recognize equity instruments at the time of purchase as FVT OCI. That is one option available to the companies. Or they can record any financial assets at the time of purchase under FVTPL. That is another option available under IFRS. However, these assets cannot be those that are specifically required to be recorded as amortized cost. So in this case, loans and advances or unlisted equity shares which are mandatorily required to be listed as recorded as at amortized cost. Apart from those assets, any assets has these options available with them under IFRS. These options are not available under US GAAP. I hope everybody is clear. So this was the most technical portion of today's class. I hope everybody is clear with intangible assets, goodwill, and financial assets, financial liabilities. Moving to non-current liabilities, that will be very simple. So non-current liabilities are those liabilities which will be repaid beyond 1 year or beyond a period of the operating cycle of the company. So long-term financial liabilities are those Financial liabilities. Again, we learned about financial liabilities, which involved a financial instrument creating financial asset for one company, financial liability or equity for the other company, and include loans, notes, bonds payable, debentures, and are usually reported at amortized cost. So for the company which has an asset, so in case of a financial instrument, one company has an asset, one has a liability, because one company will be paying and one company will be receiving. The one company which will be receiving the payment will record an asset in their books, because there will be inflow of financial gains in future, whereas the other company will be reporting a financial liability, because there will be outflow of financial of financial gains from the company. So for the company which is reporting a liability, will be recording them at amortized cost in the balance sheet. We just have to remember this in case of non-current liabilities. We do not have all the details of FET, OCI, FET, PL or amortized cost in case of liabilities. Upon maturity, the amortized cost of the bond or carrying amount will be equal to its face value. What does this mean? Let us take an example. For example, I issue a debenture at discount. So face value is $100,000. I issue it at $90,000. So currently there's a difference between the book value and the face value. So the company which bought the debenture will record $90,000, that is the amortized cost. However, the face value of the debenture is $100,000. Now let us say the debenture will be repaid over 10 years. So the discount of $10,000 will be recorded as income for the company which is holding an asset every year, and for the company which is holding a liability, since it got only $90,000 initially, over the 10 years, so $10,000 is the value of discount divided by 10 equals to $1,000. So the $1,000 will be added to the value in the books of the company every year. At the end of 10 years, the book value will be $100,000, which will be equal to the face value of the debenture. This is what it means to say, upon maturity, at the date of maturity, the amortized cost, that is the book value of the bond or carrying value, will be equal to its face value. At year 5, what will be the book value? At year 5, $5,000 have been added. So the book value or amortized cost of the debenture in the books of the company will be $95,000. However, the face value is $100,000. So there's a difference. However, on the date of maturity, the book value of the asset or liability will be equal to its face value. Again, deferred tax. Now let us understand about deferred tax. Need to finish fast. What are deferred tax? So deferred tax might be assets or liabilities. You saw that when we were reading about non-current assets, then also we talked about deferred tax, and when we are reading about non-current liabilities, then also the concept of deferred tax comes about. Now where does this difference come from? What is this item? So when we are paying income tax, let us say the company earned an income of $100,000, and the tax rate applicable is 30%. Tax rate is, so the tax should be $30,000. Correct. However, it might not be so. There might be temporary difference in the value of certain assets and liabilities for the company. For example, the most famous and common example is that of fixed assets. So as per the law of the income tax, a different rate of depreciation might be applicable for a asset. Let us say the company owns a asset, a machine, and as per the management's depreciation following as per the Companies Act of the country, the depreciation is coming to $10,000. However, the income tax requires the company to follow a more aggressive depreciation method. For example, as per the normal books of accounts, the company is following straight line method of depreciation, SLM, which we have already learned about. But income tax mandates double declining method, which we have also learned about. So in case of double declining method, what if the depreciation is $20,000 instead of $10,000? So what will happen in this case? The company will get an additional deduction. So the company, instead of $10,000 and instead of the profit getting $100,000, there will be an additional 10,000 deduction for the company, and the profit will be $90,000 for income tax purposes. Net profit for IT equals to, for income tax, will be $90,000, and tax will actually be 90,000 multiplied by 30% equals to $27,000. So the company had to pay $3,000 less dollars as tax, but in the long run, will that benefit hold? The tax base, that is the value of the asset for which the value asset was purchased, that remains the same under both income tax and Companies Act, or the book value. So what does that mean? Initially, even though you are getting more deductions, later you will get lower deduction under IT and you will get higher deductions under your book value. So this has led to the creation of a temporary difference. Now let us consider the machine value was $100,000 again. So in the books, the book value, WDV, the written down value of the asset for the company, will be $90,000. However, if we create a different balance sheet for tax purposes and call it tax balance sheet, then the book value for the tax balance sheet, instead of 100,000 minus 10,000, it will be 100,000 minus $20,000. So the book value for tax purposes, let's call it the tax base of the asset, is $80,000, right? So the asset value in tax balance sheet is different, and the assets value in the normal balance sheet that the company is preparing is different. This is creating a temporary difference. These arise from temporary difference between the reported income for financial statement purposes and taxable income of a business entity. Specifically, deferred tax liabilities occur when the taxable income of a business entity and the actual income tax payable derived from it is less than the reported financial statement income and the income tax derived from it. What does this mean? So in this case, in the example that we are taking, in this case, the net profit for income tax purposes is lower than the net profit that we have reported in the books, right? So since we are paying a lower income tax right now, that means that we will have to create a higher income tax at a later point in time. So this difference, since we have to pay a higher income tax at a later point in time, what does that mean? There will be future economic outflow, right? Because the net income of books is higher and the net income as per income tax is lower, that means in future we have to pay a higher tax. So this leads to the creation of a deferred tax liability. I don't believe that we have any sums for deferred tax liability in level 1. You just need to understand the concept of deferred tax. If there are any sums relevant for deferred tax, we will be doing it. But for now, just understand that deferred tax means that there's a temporary timing difference between the income presented as per books and the income as per income tax, which leads to the creation of an asset or liability. If the income tax profit is higher right now, that means we will need to pay a lower tax in the future. That will create an asset. And if we have to pay a higher tax in the future, then we will need to recognize a liability. That is the only thing that is relevant for level 1 purposes. The formulas and all the calculation of deferred tax is there in level 2. So I hope everybody understands the concept of deferred tax. In case you have any queries, you may contact me. Now, moving forward to component of shareholders equity. We already learned that shareholders equity is the excess of assets over the liabilities of the company, right? So what are the components of shareholders equity? The main owners, the equity shareholders of the company, they have also invested money in the company. There is a separate class of shares called preferred shares, which we learned about yesterday when we were doing earnings per share. I hope everybody remembers the meaning of preferred shares, which means they are also owners of the company. That is, their capital is not guaranteed back to them. However, they are guaranteed a certain percentage as dividends every year. So even if the company, in case of preferred shares, the company is guaranteeing them a preferred dividend. So even though the principal is not guaranteed back, their dividend is guaranteed to them. That is preferred shares. So let us read the first two paragraphs. Capital contributed by owners, that is equity shares in this case, the first kind of shares. This is the amount of capital that was contributed to the entity by its owners, the initial money that flew in. For each class of common shares issued, the entity must disclose the number of shares authorized, issued, and outstanding. So what does this mean? Let us see here. Authorized. What spelling? Authorized. See, so it writes that as per the law of the company, Facebook is authorized to issue 5,000 million class 1 shares. That is the authorized capital. Facebook is authorized to issue. They have not yet issued. The money is not yet received. In reality, Facebook has issued how many shares? In reality, Facebook has already issued, for which money has been received, 2,328 million Class A shares. So I hope you understand. Authorized is the number of shares which the company is authorized to issue. Issued is the number of shares which the company has actually issued. So this is the amount of capital that was contributed to its entity by its owners. The authorized number of shares. Okay, now there's one more concept, that is reacquisition of shares. Now let us say the shares of Facebook are trading in the open market. What if Facebook itself buys its own shares? Facebook buys its own shares in the open market. Now these shares which have been bought by Facebook will be called treasury shares. These shares are referred to as treasury stock also. They are the shares in a business entity that it has repurchased. Repurchase of shares reduces the shareholders' equity by the amount invested in the acquisition of shares. I hope you all understand. So the outstanding number of shares with the public will be the total number of issued shares minus the treasury shares or the shares which is repurchased by the company. Preferred shares are those shares which have special rights, that is the right to receive dividends. However, there might be certain restrictions with preferred shares, that is they might not have voting rights. Every equity share along with the right to ownership, they have voting rights in the company. Whenever there are any shareholders meeting, people holding equity shares will have a right to vote in the shareholders meeting. So that is what the right from owning equity shares gets you. I hope this point is clear. Moving forward, what is retained earnings? Retained earnings, as the name suggests, the company keeps on earning profits year after year. So the cumulative value of the profits and losses, it might be positive or negative if the cumulative amount of profit or losses is minus in negative. So that will give us the retained earnings of the company, and it also becomes part of the owner's equity. Then we learned about other comprehensive income. Like we understood the components of other comprehensive income in our previous class. The value of other comprehensive income becomes a part of the owner's equity and is recorded separately as accumulated other comprehensive income. And finally, non-controlling interest. We have already discussed about minority interest again in the previous class. Minority interest means, if a company owns a subsidiary, then they might not own 100% value of shares of the company. For example, let us say Meta is owning WhatsApp as a company. Meta owns 100% of WhatsApp, so there is no issue. However, if Meta owned 90% of WhatsApp and 10% was owned by somebody else, in this case, the 10% shareholding is called the minority interest. It is shown separately in the balance sheet. Now, in the annual report, the company is mandatorily required to show the statement of changes in equity. Hold on. This is it. So this is the statement of stockholders' equity. You can see it has the shares, the accumulated other comprehensive income, retained earning, and total shareholders' equity. So everything that we talked about is mentioned here, right? The shares, the accumulated other comprehensive income, and retained earnings. Additional paid in capital is similar to shares. That is the additional money that was called in from the shareholders. So I hope everybody understands the meaning of the components of shareholders' equity. Final two topics of the day: common size balance sheets. Like we talked about common size income statements. When we were talking about common size income statements, we presented every line item of the income statement as a percentage of the revenue. In case of common size balance sheets, it is presented as a total of the total assets. So assets equals to liabilities plus owner's equity. This is very clear with everybody. So let us say cash 2300, account receivable 3700, current plant and machinery 32,500, and goodwill 1750. So the total assets comes to 45,750 for company A. And company B, let us say the same are 1500, 11, 1500, 1100. Okay, I missed inventory. I'm sorry. Inventory is 5500, 1500, 1100, 900. Plant and machinery 11750 and 0 goodwill. So in this case, total assets is 15250. So looking at this, what does this tell you? This is very absurd because we cannot compare two companies with so different scales. One company with 45,000 and the other with only 15,000. So company A is 3 times that of company B. So is it proper? Can we actually compare company A and B? What will be a better format? So what we will do is we will take every number. For example, cash. We'll take 2,300 divided by 45,750. So company A, company B. So in company A, this is 5%. Account receivable, inventory, plant and machinery, and goodwill. Okay, I'm doing this quickly. I'm just copying the figures. 8%, 12%, 12%, 71%, and 4%. Whereas for company B, those comes to 10%, 7%, 6%, and 77%. So even though the figures look so different and the values are so different, when we look at the common size balance sheet, we will understand that the investments are very similar. And both the company have around 70 to 80% invested in the plant and machinery, and the rest are current assets. Only the 4% different of goodwill in company A. This gives us a much better picture. Similarly, even for liabilities and equity, we can do the same, and we can divide them by total assets or total liabilities and owner's equity. That figure will be the same. This will give us a much better perspective as a financial statement analyst. And this will help us in making a better analysis of the company. So I hope everybody understands the meaning of common size balance sheets. Common size balance sheets can assist with time series analysis by comparing the balance sheets of the two companies over time. For example, Meta, if we see that the company is growing exponentially every year. So if the company is growing every year, if we compare 5 years the data 5 years before and company's data today, it will be absolutely non-comparable because there will be a major magnitude of difference. But if we do a common size balance sheet, then we will be able to understand whether the percentages of investments are similar. And cross-sectional analysis is the one which we already did, that is comparing two companies which may be different in scale. We did the vertical common size balance sheet, and this is what is relevant for your exam. We do not need to understand about horizontal common size balance sheet. However, we will just mention it. Horizontal common size balance sheets reflect quantities on the balance sheet in terms of the base year. That means that we will select a base year, for example, like 5 years before and today, and we will select the base year's total assets, and that will become the base for every item. That is not relevant for your exam. We will just be looking at the vertical common size balance sheet, which is much more popular of the two methods. I hope common size balance sheets are clear. And finally, last but obviously not the least, this is the last topic of the day, and we are going to discuss about ratio analysis. Initially, when we started today's class, we talked about liquidity and solvency. We talked about how we can look at the balance sheet of the company to understand whether the company is liquid and whether the company is solvent. And by liquidity and solvency, we meant liquidity means being able to repay its short-term liabilities, and solvency means the ability to repay its long-term liabilities. How do we judge the liquidity and solvency of a company? A much better idea to understand these would be to use ratios. Ratios give us a much better understanding. A current ratio means all current assets of the company divided by all current liabilities. So if the current assets are greater than the current liabilities, the ratio will be greater than 1, which is always ideal for a company to maintain a current ratio greater than 1. Rather, some people recommend maintaining a current ratio of as high as 2. So that means the current assets are double the current liabilities. In such a case, the current ratio will help us understand that the company has enough current assets to repay the current liabilities that are outstanding in the company. What were the components of current assets, everyone? Really quickly, we had cash and cash equivalents, we had marketable securities, we had accounts receivable, we had short term loans and advances, and other current assets. All these were components of current assets. So if the total current assets are greater than the current liabilities, then the ratio will be greater than 1. And what does this give us? Liquidity or solvency? So these all are liquidity ratios, because these talk about short term. If you look at it in the denominator, all the liquidity assets or liquidity ratios will have current liabilities. Why? Because liquidity means the ability of the company to repay its short term liabilities. So current ratio, which is the one of the most important ratios, means current assets divided by current liabilities. Now what does quick ratio mean? In quick ratio we do current assets minus inventory minus prepaid expenses divided by current liabilities. So we are removing two components from current assets: inventory and prepaid expenses. Why? Because even though inventory and prepaid expenses are short term in nature, inventory might not be sold. Inventory are not as liquid as the other ones. Inventory is not as liquid as cash, marketable securities, or accounts receivable. And prepaid expenses is not an asset in the sense that money will not be coming to you. It is something you have paid for which you will be receiving benefits. So you cannot use prepaid expenses to repay any sort of liability, right? So if we reduce those two points and then we divide by current liability, and this will give a better understanding of the liquidity of the company. I hope that is very clear with everybody. What is a quick ratio? It is called a quick ratio or an acid test ratio. A quick ratio is more strict than the current ratio. So quick ratio is cash plus marketable securities plus receivables divided by current liabilities. Two things that we are not adding are inventory and prepaid expenses, which although form a part of current assets, but they are not a part of quick ratio. And finally, cash ratio is only cash and marketable securities divided by current liabilities. So even accounts receivable might become bad debt and might not be payable. So cash ratio is the most strict ratio in among the liquidity ratios. We learned about three liquidity ratios with increasing order of strictness: current ratio, which is current assets divided by current liabilities; quick ratio, which is current assets minus inventory minus prepaid expenses divided by current liabilities; and finally cash ratio, which is cash and marketable securities divided by current liabilities. So as long as all these ratios are greater than 1, we know that the company's liquidity is in a good situation. If the ratio falls below 1, that is when you should, as an investor, worry about the company's liquidity. And finally, we come to solvency ratios. This means the company's ability to meet its long term liabilities. Okay, so we already know what are non-current liabilities or long-term liabilities. These can be long-term debts which the company has to repay. These might be financial obligations. The company might have taken loans and advances from banks or financial institutions. All these are long-term abilities. So we need to know what are the long-term liabilities and whether or not the company will be able to meet those debt obligations. To meet those debt obligations, what are the assets available to the company? We will look at that. So what is total equity and why is total equity relevant to measure solvency? Total equity is assets minus liabilities, right? That gives us total equity, total assets minus total liabilities gives us total equity of the company. So if we compare the total long-term debt of the company to the total equity of the company, that will help us understand how many what are the assets of the company beyond the liabilities. I hope that is clear to everybody. So this will give us an understanding of how much debt the company holds and whether or not the company will be in a position to repay those long term debts. Next, debt to equity ratio. This is the most famous solvency ratio and most important solvency ratio. Debt to equity. Total debt to total equity, it's very similar to total long-term debt to equity. The only difference is it considers both long-term and short-term debt. So it means the total debt of the company is being compared by the total equity of the company. This will help us to understand whether or not the company has a standing in the long term. What do we want? We always want that the company's equity should be more than the long term debt or the total debt. We want our equity value to be higher than our debt, right? So the lower the ratio, the better it is for the company in these two cases. Next, we come to the total debt of the company. This is also long term debt plus short term debt divided by the total assets of the company. So if we look at the common size balance sheet, this will be very simple figure to figure it out. We already have the percentages. We'll just add up the percentages of the long term debt and short term debt, because in a common size balance sheet, we already present every figure as a percentage of the total assets. So total debt divided by total assets will give us total debt ratio. Now, do we want more debt or less debt in our company? Obviously less debt, because debt creates an obligation to pay in the future. So again, the lower the better. In every case, in the first three ratios, lower is better. However, in the last one, which is financial leverage, that is assets divided by asset minus liabilities. In this case, we want the liabilities to be as low as possible, right? We want the liabilities to be as low as possible. So in this case, we want this ratio to be higher, because higher total assets as excuse me. Okay, I'm really sorry, guys. Okay, so sorry, the formula was correct. So assets divided by assets minus liabilities. We want the liabilities to be as less as possible, and we want total equity to be higher. So even in this case, if total equity is higher, that means denominator, we want the denominator to be as high as possible. Again, in this case, lower is better. So for liquidity ratios, higher was better, and for solvency ratios, lower was better. So this concludes our ratios We are running late, so we won't be able to do examples, but I hope the formulas are fairly simple and you will be getting straightforward sums relating to these. Analysts must understand the limitations of balance sheet ratio analysis. There are certain limitations. Comparisons with peer firms are limited by differences in accounting standards and estimates. We already know that different companies follow different accounting policies. So we need to understand the differences in accounting policies before calculating the ratios. Lack of homogeneity in as many firms operate in different industries. So there are many different items that are included in the different line items. There, for some companies, current assets might hold different items. For others, it might hold different. So there's no homogeneity. So that's why we need to make sure we keep that in mind before comparing companies operating in different industries. Interpretation of ratios require a lot of judgment. Like I said, higher is better. However, how high? If the current ratio is 100 to 1, is that good? No, we do not want such a high ratio. We want current assets to be very close to current liabilities, although higher, but we do not want a very high value. What is the perfect figure for a current ratio is a matter of judgment for the analyst. And finally, balance sheet data are only measured at a single point in time. So again, even though we are comparing ratios, we are looking at ratios which were calculated taking into account the ratios of a particular point in time. The values keep on changing, but we do not incorporate the changes as and when the changes are occurring. I hope everybody understands. And we have completed LOS 19. I'm sorry, this was a very long class. Now let's just quickly go through everything that we have learned. We started with the components of balance sheet that included assets, liabilities, and equity. Assets refer to the resources which the company used because of a past event which results in future economic benefit to the company. Liabilities are the opposite of an asset. It also occurs because of a past event. However, there is outflow of economic benefits instead of an inflow, as was in the case of assets. Owner's equity is the excess of assets over the liabilities of the company, which is equity equals assets minus liabilities. Then we went to uses and limitations on the balance sheet. As the balance sheet can assist analysts in assessing a company's ability to pay for its near-term operating needs, meet future debt obligations, and make distributions to the shareholders. The limitations of balance sheets were some assets and liabilities are measured at historical cost, while others might be measured at fair value or other measurement bases. So we need to make sure that we understand everything before making a decision. The value of an item reported on a balance sheet is on a particular point of time. If you are analyzing the company at a later date, these values might have changed. Some assets and liabilities are difficult to quantify. For example, the goodwill, the customers, loyalty, the human capital, these items are difficult to quantify and cannot be put in the balance sheet of the company. There are we discussed about two alternative formats of a balance sheet. One was the classified balance sheet, which included the current and non-current classifications for assets and liabilities, and the second was liquidity based balance sheet, in which the assets were recorded on based of their liquidity from most liquid to least liquid. Then we went to current and non-current assets. We learned about current assets are those which are expected to be used or which are expected to be realized or sold within 1 year or within one operating cycle, or non-current assets are those which are expected to be used, sold, or realized over more than 1 year or one operating cycle. Operating cycle is the time taken to produce or purchase inventory, sell the inventory, and collect the cash. Then we learned about current liabilities and non-current liabilities. Even though they were very similar, a asset is a current liability if it fulfills any one of the following criteria. Number one, the liability is expected to be settled during one normal operating cycle of the business entity, or the liability is expected to be settled within 1 year, or the liability is held for primarily trading purposes. Number four, there is no unconditional right for deferral of settlement of the liability for at least 1 year. That means we do not have any unconditional right to defer the liability for at least 1 year after the balance sheet date. Non-current liabilities are those liabilities which are not current. Then we understood the meaning of several current assets, that is cash and cash equivalents, that is cash and bank balances. Marketable securities, which were those securities which were not included in the cash and cash equivalents, that is more than 3 months will be required to realize them. Then we went into trade receivable or account receivable, which were the debtors, that is the people who require to pay us money for selling us goods or services. Then we went on to inventories. Inventories are physical products that the company intend to sell to its customers. We learned about FIFO LIFO already in the previous class. Today we learned about how IFRS requires classification of inventory under lower of cost or NRV, whereas the US GAAP requires classification or recording of inventory under lower of cost or market value. Then we realize the difference between market value and inventory. Market value and net realizable value. We heard that net realizable value is the value that we expect to sell the product for minus any selling expenses and conversion expenses that the company is going to incur. We learned that the market value cannot be higher than the net realizable value, and at the same time it cannot be lower than the net realizable value minus any normal profit margin. Then we learned about current liabilities. We learned about trade payables, and those are the amount that we owe to our suppliers from whom we have purchased goods or services. Then we went on to notes payable, which are financial liabilities, accrued expenses, which are the amount payable for other expenses, and deferred income or unearned revenue, which is the money we have already received for which we have not yet supplied the goods or services. Then we learned about non-current assets. We learned about property, plant and equipment, where the US GAAP allows only the cost model, but the IFRS allows both cost and revaluation model. Investment property are those long-term assets which are held for either rental or capital appreciation, whereas PPE was held for operations of the company. And under IFRS, even these are allowed both cost or revaluation method, or in this case as it was called the fair value model. Then we learned about intangible assets are those assets which are not tangible and it cannot be touched. However, they give us future economic benefits. For example, we learned about trademarks, patents, copyrights, all these. And then we learned about how goodwill is an unidentifiable intangible asset. Then we learned about US GAAP permits only the cost model under intangible assets as well. However, IFRS allows both the cost model and the revaluation model. Then in the case of internally created identifiable intangibles, IFRS and US GAAP both require them to be expensed. However, under IFRS, there needs to be a distinction between the research phase and the development phase. Under the research phase, all expenses that have been incurred need to be expensed in the income statement. However, any expenses that are incurred during the development phase can be capitalized, are allowed to be capitalized. However, US GAAP does not allow any capitalization and everything needs to be expensed under the US GAAP. Then we learned about goodwill. How there's a difference between accounting goodwill. Accounting goodwill is something relating to the past. Accounting goodwill means goodwill that generates out of excess payments for any acquisition of a company that we are doing. However, economic goodwill looks in the future. Economic goodwill relates to future performance and the future expected benefits that we get and the excess of market value over the book value of the company. That can be called as an economic goodwill. Both IFRS and US GAAP require the capitalization of accounting goodwill that arises from acquisitions. And goodwill is not required to be amortized. However, goodwill is required to be tested for impairment at every reporting date. Then we learned about financial assets and how financial assets can be three. That is, they can be recorded at amortized cost, market value through profit and loss, or market value through other comprehensive income. How do we determine that? Number one, we test. There are two tests. Number one, the cash flow test, whether the cash flows that are incurring are due to principal and interest. If the cash flows incurring are due to principal and interest, and the business model that is to be held for maturity, in that case we will follow the amortized cost method. If both the tests are not being fulfilled, then we will go to measure through FVTPL or FVTOCI. FVTPL is fair value through profit and loss, fair value through OCI. Fair value through profit and loss under IRS is for held for trading securities. Those securities that are held for trading will be recorded under FVTPL. There, the changes in the unrealized gains or losses on those securities will be recorded in the income statement. Whereas in FVTOCI are those securities which are available for sale. However, the management does not intend to sell them immediately. In those cases, they are recorded under the OCI. The unrealized gains or losses of those securities are recorded under OCI. Next, we learned about, unlike IFRS, the US GAAP category of available for sale applies only to debt securities, and it is not permitted for equity securities. Then we learned certain points about IFRS. We learned how IFRS allows a one-time irrevocable options to record all equity securities as FVTOCI, or for every financial asset an irrevocable option to record them at FVTPL. These were the two options available under IFRS. Then we went to non-current liabilities, long-term financial liabilities. We learned about how they are to be recognized as amortized cost and how long-term liabilities at maturity will be the same as their face value. Then we learned about deferred tax, which arise due to temporary differences between the income statement as per books and as per the for tax purposes. Then we learned about the components of shareholders equity, which include shareholders common shareholders equity, that is equity shareholders, preferred shares, treasury shares. Treasury shares were the shares that had been repurchased by the company. Outstanding number of shares refer to the shares that had been issued minus the shares that have been reacquired by the company. Retained earnings is the cumulative profits of the profit and losses of the company, and accumulated others comprehensive income is the accumulated OCI, which we have already read about in the statement of financial performance. Then we learned about non-controlling interest, how they refer to the minority interest of a company. Finally, we came to common size balance sheets. In common size balance sheets, there are two types of common size balance sheets: vertical and horizontal. We only care about the vertical common size balance sheet, where all line items are represented as a percentage of the total asset or total liability and owner's equity. And finally, we went to ratio analysis. We learned about liquidity ratios and solvency ratios. Liquidity ratios help us to determine whether or not the company's ability to meet short-term liabilities or short-term obligations. What were the liquidity ratios? Current ratio is current assets by current liabilities. Then quick ratio or asset test ratio, which is current assets minus inventory minus prepaid expenses divided by current liabilities, or instead we can also say cash plus marketable securities plus receivables divided by current liabilities. And finally the cash ratio, that is cash plus marketable securities divided by the current liabilities. The strictness of the liquidity ratios increased from number 1 to number 3. And then finally we went on to solvency ratios, which test the ability of the company to meet its long-term obligations. Number 1, long-term debt to equity, that is long-term debt divided by total equity. For debt to equity, total debt to total equity. Total debt ratio is the total debt to divide by total assets of the company. And finally financial leverage is total assets by total equity. In case of liquidity ratios, the higher was the better, and in case of solvency ratios, the lower was the better. However, this includes a point of judgment for the financial statement analyst, and they might consider a certain level to be appropriate for any company depending on the industry in which the company operates. That is it for today's class, everybody. Thank you so much. Before leaving, I would request everybody who's watching on YouTube to please like, comment and share, and press the bell notification tab to receive all notifications from our channel. And if you are going to buy our classes, go to meplclasses.com and use MEPL2023 code number to get a huge discount. Thank you so much, everybody. See you in the next class, where we'll be going forward with